Hi everyone, this is Matt Curfman here with Richmond Brothers for the March edition of Matt's Minutes. Thank you for tuning in. I thought I would start off and just let you know that we had a really great turnout at our State of the Money presentation that we did over at Ella Sharp during the month of March. We had two sessions, one in the afternoon and one in the evening. Both were very well attended. And then we've also sent the link out to that presentation in case you haven't gotten it or haven't had the chance to look at it. Kira tells me 2 times already, so we've gotten incredible feedback. Thank you so much for letting us know what you liked and then what we can improve on and if there's other information that would be helpful. So as we look at the first quarter and really the end of March for 2019, before we jump into that, I wanted to go back and just, we came off of a pretty rough fourth quarter in the broad markets. You had the government shutdown, you had the Federal Reserve saying they were going to keep raising interest rates. Keep in mind that was in December when they said that. You had the midterm elections, and then you still have U.S. and China trade relations as topics. So now that we've almost gotten into the first quarter, put a lot of that behind us, 3 of those 4 things were already satisfied in effect. So the government is no longer shut down, midterm elections are behind us. The Federal Reserve, in effect, has come out in March and reversed course and said they're going to keep rates flat rather than continue to raise them like they had indicated in December. And so, to us, when the Federal Reserve says they're going to keep rates flat, that's great for borrowers, but from the market and the economy standpoint, what that really starts to give us an indication is that the economy is starting to slow down. Typically when the Fed is rising or increasing the rates, that's usually as a result of the economy doing so well. So we would look at that as an indicator that basically just suggests that sometime in the next 12 to 18 months, assuming they keep rates flat, the economy is slowing down, but it's slowing down from a higher growth period, so it's still growing, just not as fast. So we want to be cognizant of potentially an eventual recession that we would forecast into mid-2020 if we had to put our crystal ball out there right now. So in the first quarter, the Dow, the S&P 500, and the NASDAQ, the broad indexes, basically for the 3 months coming out of the bad end of the year, returned 11%, 13%, and 16% in price returns. If you average those 3, it's about 13.5%. I took a snapshot of what overall, this is not your individual portfolio, but when I look at all of the equity bucket or basket of investments we have for clients that fall under that category, how they have done year to date, just to compare broadly with the markets. And as of March 30th, our equities were about 30% higher than they were December 31st. That would be comparable to the 13.5% for the average of the 3 broad markets. So we're really happy to start seeing those numbers, and I'm sure as you've gotten monthly statements, you've generally seen better and better numbers coming off of the fourth quarter. So what's the plan? What do we want to do? Do we just sit back? I want to kind of just keep educating you a bit. We talked a lot in our seminar and even more recently about Riskalyze and kind of some parameters of investment. So a risk 1 all the way to a risk 99. And just as a refresher, a 1 would be very conservative, so CDs, maybe money markets, even guaranteed things like fixed annuities. A 99 would be very aggressive, and that would encompass most individual stocks. 25 would be the core bond index, and a 75 would be the broad stock market. So kind of if you think of it in that respect, the higher you get on the risk profile, the more volatile each holding in your whole portfolio is going to be. So what's the plan as we continue to move into 2019? I wanted to give you some examples. So most people think big name companies are really safe and stable in their share price. The companies might be doing fine, but it doesn't mean they're not going to be really volatile. Amazon, as an example, is a great company, and I probably have an Amazon box sitting on my front door right now, as most of you probably do, at least on a weekly basis. They have a risk profile of a 92. Way over here on the risk, and what that means is they have a range of negative 30% to plus 49% returns. That's a pretty wide range, even though in our minds that's a stable company. And then I would just say that as we continue to have the market go up and we keep skimming off the top this year, we'll plan to keep taking some of that and we'll be individually reviewing each of your allocations. with the thought that eventually we come to recession. So we want to skim from the top when possible and start putting in more safety nets or more risk 1, 5, 20s, not more risk 90s. And so that's effectively what I would continue to see and expect from us throughout the year. And the last slide, or the last piece you can see on the screen, is again that roller coaster. And I just wanted to revisit this. You've seen this before, but we've added a timeline just to kind of let you know as we're coming back up the hill, meaning prices are appreciating. There's going to be a time frame, I don't know when, but when the market effectively crests over the top again, and we're going to want to start taking off the top, getting more conservative, and shoring up on this side. So with that, if you have any questions, as always, reach out to us, questions@richmondbrothers.com. Thank you for your continued confidence and trust, and we appreciate having the opportunity to work for you.